Kim Cash and I, my name is Janice Kitzman, and we were at the GIPS conference a few weeks ago. It was a good time. If you didn't get to go, highly recommend it. We'll see what topics are available next year. But we just wanted to share with those that didn't get to go what we took away from it and what we think advisors really need to be focusing on and knowing in this next year with the new marketing rule and the implementation of that rule. Hopefully all of you on this call know that the rule is in effect now. So with that, we're really just going to cover kind of at a high level some marketing rule interpretations, some IRR calculations, OCIO, ESG, model portfolio, and then we've got about 3 case studies at the end if we get to them. But I think the thing to know during this webinar, if you haven't joined us before, is we prefer it to be interactive. We actually would prefer not to be just talking at you. We would like to be talking with you. And so what we've done is we've put in some Q&As into each of these sections. And if at any time you have a question, and you can either raise your hand or put it in the chat or just unmute yourself, we're happy to answer those questions. So we really want this to be an interactive time together. And with that, Kim is going to talk about the marketing rule interpretations.
Okay, great. Thank you, Janice, and thank you everybody for jumping in today and spending a little time with us. So I have been part of GIPS conference reviews for at least 15 years, did them at Ashland after every in-person GIPS conference, did them at Cascade, and haven't for a couple years because we haven't been in person and didn't really necessarily want to do a webinar overview of a webinar. But here we are. We had an in-person event and they spent the first 3 hours talking about the SEC marketing rule. It was interesting. We had an SEC staff person, Christine, and I may mispronounce this, but Schleppel. So we had SEC perspective, we had an attorney's perspective, and then Schlepp-Grell, excuse me. And then we also had CFA Institute perspective. So yes, it was interesting and it was informative. You had to kind of pull new information out though, because really what it was a dialogue that was not conclusive. So if you went to the conference thinking, okay, maybe 2 weeks before the marketing rule, we're going to have something conclusive on some of these gray areas, then you might have left disappointed. But they did do quite a few case studies. We've added a few to our presentation at the end of the conversation today as well. Some of our own case studies, because that's kind of nice to just have some examples. What I'm taking away from the GIPS conference 2 weeks ago, not particularly 3 weeks ago, not being particularly conclusive, and also just this week, if you participated in the CCO outreach, nothing, a lot of back and forth. These are principles-based rules. And so we're not going to get that much prescriptive yes, no. And it is going to be facts and circumstances based. And so a lot of your answers to some of these gray areas is going to depend on your firm's appetite for risk. So I don't want to say that that's kind of that you can do anything you want. There are general prohibitions, and they're all from past no action guidance. And even 1940s, you can't omit facts and you can't mislead, you can't lie. And in 3 of the 7 general prohibitions, you can't not be fair and balanced. So that's really important to weigh. And I think there's a lot of history around, if you're going to show your best 3 or your top 10, you need to show your worst 3 or your 10, so that you're being fair and balanced in however you're presenting your information. And those are still good guide rails because those general prohibitions that are requiring you to be fair and balanced in performance results, in describing benefits, or any kind of specific advice, that still applies. And then materiality is also a big part of those general prohibitions. And so if you're materially misleading, material facts, so again, you don't want to, I mean, one of the things people are looking for is, well, how similar does related account performance have to be to the representative account to be able to still show it? Well, there is no magic number. And again, that's where it's really going to be facts and circumstance based. So, because there's been a lot of discussion and not a lot of conclusions, one of the things I thought I would like to do in this summary is take the very first topic that they addressed at the GIPS conference and make it kind of, here's practical guidance. So, taking everything I've just said, the very first conversation that came up for question was, what is performance versus what is a performance characteristic? So you now have to, the rule is now in effect as of November 4th, you have to document your firm's policies and procedures for how you calculate performance. And if your firm is grappling with, well, what are we going to do about risk adjusted returns? Do those have to be net or can they be gross? What about specific alpha, beta, Sharpe ratios? What about attribution? So there are no answers outside necessarily. If you've listened to the conversations, you've heard maybe, maybe not, but what you can create in your firm are policies that definitely, define net performance, define gross performance, but then give some examples of performance results that show what the investor would take home, which is definitely something the SEC examiner, Christine, emphasized at the GIPS conference, and we continue to see that kind of emphasize. So time-weighted returns, IRRs, excess returns, and then distinct from that, add to your policies investment performance characteristics, and that you demonstrate, you're not trying to demonstrate what an investor takes home, but rather how the strategy achieved its results. You could add that it's often compared to benchmarks that are not net of fees, that are gross of fees. And so you use performance results before fees to better explain the relative drivers and risks of the strategy. So with that kind of in your policies, you can even give examples. Standard deviation, composite dispersion, the SEC staff have all been pretty quick to nod their head and say, sure, you can show those gross. The GIPS standards recommend gross, you can do that. Risk adjusted returns, you're starting to move along the continuum more to returns based data that might be better gross of fees than if it was presented net of fees, but it's still a characteristic, not performance. So you can include that. And then attribution was something discussed specifically at the conference, and even on the one of my colleagues from our firm was on the CCO outreach call, and the staff person is saying that could be extracted performance, and the attorney was saying, we sure do hope sector attribution can be shown gross of fees and not be considered extracted, that has to be net of fees. So again, I think put this in your policies, and there's a lot of power there to then do what you say you're doing in your policies, because these are principles based. And as long as you're being fair and balanced, you're going to want to pass the facts and circumstances, but that's really primarily going to be real helpful for you. You'll still have to think about other considerations in the presentations themselves. So specifically with attribution, one of the things they talked about at the conference was, well, what if it's shown in isolation? So what if you have one sector that's done really well, and so you create a whole slide in your deck that talks about how well this one particular sector has done? That could be deemed extracted, and then that would be required to be shown net, even though in maybe your policies you say attribution is a characteristic, and we're we're going to be able to show it gross because it's really just showing the drivers of the performance. So how it is presented also needs to be something that CCOs and firms need to be reviewing to make sure it's fair and balanced. And I would say, in terms of other considerations, if you are showing attribution gross of returns, that somewhere on that page, you're actually including the total return net, or at a minimum, you're referencing it somewhere else. So where are those required net of returns? Where are the prescribed time periods? If they're not right on that page with that gross attribution, then at least they're referenced. And then just think about placement, think about size and color, but also graphs. I think one of the things that came to a lot of people's surprise is when you think you're showing everything equally prominent, and then you realize there are some charts and graphs that are gross only, or like peer review. So if that's really a performance number, and if the net data is available, then perhaps it needs to be both gross and net. But if there is no net data available, then that's a pretty reasonable case to be made for showing it gross. And maybe, so considerations about how that's being presented, and documenting it so that you can support why you've made the decisions that you've made. Okay, other areas discussed at the conference in this first 3 hours of SEC marketing rule discussions, lots of conversation around net. So is it okay to use actual if there is, a difference, if there are some low fee paying accounts, and maybe you're offering a 1% fee, but because of all your big accounts paying lower fees, your real difference between gross and net, which we call the effective fee, maybe that's closer to 70 or 80. Is that material? And in that case, maybe you need to use model, but then what about what model do you pick? And one of the more informative conversations in that section of the 2 sessions on SEC marketing rule was when the attorney was really trying to get the SEC examiner to say, if we've done the work, we've created the model that's relevant for this particular client, and we're putting it next to either an institutional model, or maybe it's an actual fee that's going to be a little lower, is that going to be okay? And the examiner would not give a nod to that, because they really emphasized performance needs to be net of a relevant fee. And so they really recommended having separate institutional presentation pages and retail pages, and not having multiple columns. And so I thought that was really interesting, and the real, that's the heart of where the prescriptive guidance is. It is on net returns, and they have to be related account returns, and the performance needs to be relevant to the prospective investor, and it has to have the prescribed time periods. And then once you get past those 3 criteria, then you've got some areas where you can get more into the principles of applying this rule. But in those areas, they didn't budge much. And we go into lots of specific questions around that, and especially with, but I also want to cover other things on this presentation. So we talked about representative account performance, and performance versus performance characteristics for that one too. I think a lot of firms show composite performance, but often will show characteristics on a representative account because it's more statistically meaningful. Is that still okay? And the answer is, yeah, probably. And you just need to have your basis. You're not misleading people with that information, but you need to have the reasons why you're picking this account. And if you're showing performance, then it's either got to not be better than the composite materially, or wouldn't be in lieu of the composite. It could be alongside the composite. Just all kinds of applications that were discussed. And then what constitutes extracted versus hypothetical carve out was also discussed, but again, nothing really conclusive there. except that they are different. But did we get a nod from the SEC that they're different? No. But can you create policies and saying, you know, this is how we're going to treat it and run it by your general counsel? And does it pass all of the general prohibitions tests? And if it does, and you know, then you're creating for yourself what you're going to lead with. And obviously, then when there is a risk alert that gives us more information now that this rule has gone into effect, you can always make changes and updates. But I do think, you know, you want to make sure that you spend some time on your policies, not just reviewing your presentations, but actually creating policies that support the why you're doing what you're doing in your policy documents. So I think I get to stop there, except, oh, there's some Q&A. That's right.
Yeah, and if anyone has questions, please feel free to start asking them. But we can go into the Q&A that we have already set out.
This was a Q&A actually asked at the conference, and it was a good example because we see growth of $1 million a lot. It's really a since inception return. And they're like, is that considered hypothetical? And the answer was no, that's not hypothetical, because you're applying real returns to that $1 million base. And so it's not hypothetical. It is performance though. So it would have to be net. And I think a lot of firms show that number gross without the effective fees. So it needs to be net. Gross could be shown equally prominent for the same time periods. But also be careful, because a lot of times you have a nice big chart for that page. And if you don't have the other prescribed time periods, you may have beat your benchmark for the last 27 years, but maybe not in the last 5 or 10 years. So really important that you're at least referencing those if they're not on the same page. Can the model fee change? Yes, it can. And it does. Fees change. And so the one thing you have to keep in mind, with fee compression, it's not really an issue if you have higher returns for the history included in that calculation. And then in more recent years, you have lower model fees applied. That's going to be fine because you're offering the current clients the lower fees. So if fees are down to 80 basis points and maybe 10 years ago it was actually 100 basis points, that's fine. The opposite is not okay. If you started with lower fees and are just such a phenomenal manager that this has become such a popular strategy that you've really raised your fees around it. Or maybe, you know, it's an ESG strategy that over time has become more and more complicated to manage and in more demand. And so you're raising your fees. That's going to be a problem if the history is a lower fee. And it's not going to be relevant to the people you're offering that fee to right now. So in that case, you would want to apply the same fee historically, the current fee, the higher fee historically. Any questions on anything so far? I started out talking too fast because I was all excited. And we have so much we want to cover from 2 days of conference. I think this is my last Q&A, and it has to do first with representative account performance. Again, it's the same answer, different flavors. You want to use the strategy fee that you're offering to the prospective client. That's going to be way more important than whatever fee the client paid if it's different, even if it's a representative account performance history that you're showing. And then finally, with benchmarks, they also change over time. And for GIPS compliant firms, there's a lot of very specific guidance on, okay, if you're going to have this benchmark in place and then change it as of this date and have a different one, versus if you change it for the history, there's different disclosure time periods that apply. But basically, of course, you can change it. And for your since inception returns, if you have different benchmarks, you would just have to disclose what periods we're using which benchmark.
All right. Thank you, Kim. Any questions? If not, I'll roll right into IRR calculations. And before anyone starts wondering why we're talking about IRR, it was a full session at the conference. And while a lot of firms don't, IRR calculations are mainly used in the private equity space, it's still something to consider. And if you're a GIPS compliant firm, there's rules that you have to follow in order to present an IRR. But I think the key takeaways here were, just a reminder, IRR measures the return on capital actually put to work instead of a TWR, which is really on the manager's performance of the capital put to work. Since with most private equity deals, you have the ability to call capital. This is really based on the manager's timing of getting that capital in. A big topic was the harmonization of cash flows. In internal rate of return calculations, we're seeing this across the board right now, is there are many different names for the same thing. And that can be confusing to a reviewer. It can also be confusing to new staff that come on to a firm. So just kind of what they recommended was breaking this down into contributions, distributions, management fees, administration expenses, and accrued incentive fees, and then net asset value. And there are different names for all of those. And then the FINRA 2021 notice was discussed. We actually have seen an uptick in the last year of a particular firm that is requiring private equity firms to comply with the FINRA 2021 notice before they get on their platform. And so we've seen firms adopt the GIPS standards calculation methodology. And this is all part of a CFA Institute memo that came out this last year. So with that, we have a really quick Q&A on IRRs, and it's, can the expenses be stripped from net of fee returns? So the net return would only include the management fee. And with IRR calcs, I would say it depends. What it really comes down to is who are you presenting your returns to and what's the purpose? So if the net of fee return being presented is not a fund, or it's not to a fund prospective investor, then you could do that. However, this is super rare in the space that uses IRRs. So if the net of fee presented is a fund and it's to fund prospective investors, that firm needs to show the net of fee performance that's inclusive of all fees to be representative. Because again, the SEC is very clear that the performance that you're presenting to clients needs to be what they would take home. I actually, it would be very rare for a firm to not present an IRR net of all fees. So with that, Kim is going to discuss OCIO performance.
Yeah, and I would just add, to the CCOs who are on the call, this is kind of all new for you to have to really be deeply involved in performance calculations. That the SEC really never required specific calculations in the past, and very often CCOs had delegated GIPS compliance to a deputy or someone in a performance or other back office team. So and then would rely on them, and that may still be the case where you certainly need your people that you can rely on. But I think there's a lot of just built-in requirement for you to have some understanding of some of these performance calculations in order to be able to do an adequate review. For the OCIO, you know what, they talked about how this particular structure of service has grown over the last few years, and throughout maybe 85 to 125 OCIO providers, which doesn't seem like a whole lot for all of the United States or globally. but they are working with asset owners who are usually quite large. So, endowments, foundations, pensions, and a lot of the challenges then that they're having, they want to comply with the GIPS standards, but there are definitely some clunky challenges. And what's been really interesting listening to this at the conference, and certainly we have a few OCIO clients, it's the same clunkiness problem we have with retail dual registrant wealth advisors who are basically in this role, not necessarily of managing a strategy. The GIPS standards were really created for, here's the investment strategy, but instead you're providing advice, and you have, a continuum of discretion. And a lot of times, you might even be hiring and firing either managers through SMA accounts or UMA accounts, or funds, picking ETFs or mutual funds. And so then you've got really the asset allocation decision. And then, of course, you have a lot of conflicts of interests in the OCIO space, at least perceived, similar to the dual registrant space, where what about if you're pushing people into influencing people to convert to higher cost services and also proprietary products? Because you get to kind of choose what they invest in, as opposed to saying, here's my strategy, which is what the GIPS standards were really originally designed to address. So they've established an OCIO working group just this year, just this fall. And it's very exciting because I think, there may not be very many OCIO providers on this particular webinar today or on our quarterly roundtables. But I think everything that this working group decides is actually going to be relevant to all wealth advisors who struggle with some of these challenges. And the specific performance challenges really have to do with, how do you define a composite when you're actually managing to your clients' IPS objectives, timeline, risk tolerances, and how do you group them together? And do you have, let's just, for an easy example, if you have a balanced account, and you've got all these different ranges. You have your moderate 60-40, you've got the ones that are more aggressive, you've got the more conservative, and returns can be very different for those clients, even if you have 3 separate groups, depending on where they fall in that continuum. Do you have to create a composite for every 10 percentage basis points? And then what do you do when the client changes asset allocations? It's the exact same challenges with these large institutional OCIO providers. How do they create a composite? They can say, well, our endowment clients typically have, very long time horizons. And so they usually have similar asset allocations. So we can group them together, but that's not always. They could have other constraints that create differences, and certainly different risk tolerances and different unique investment policy statements. So constructing the composites is challenging. And then I think what is unique to the OCIO, at least with my wealth advisory analogy, is the legacy illiquid assets, because most of these large institutional clients do have private investments, whether it's private equity, private credit. And when those transfer in, the legacy assets, technically they may have discretion, but they can't actually do anything. They're locked in for a few years. So that is a challenge, and it is unique as far as the continuum of legacy assets, but certainly legacy assets are something that any wealth advisor also has to address. Benchmark selection is a little tricky. Again, if you want to weight it, portfolio weighted based on whatever the client's investment policy statements are saying, this is going to be the benchmark that you are going to be evaluated by. So let's evaluate your performance relative to that. And then that can get very complicated when you have multiple clients, related account groups put together for compliance with the SEC marketing rule. And that is the one final slide I will have on this particular topic. Is basically saying, how do you think the SEC marketing rule is going to affect OCIO firms, since it's going to require composites of all related portfolios? In the session at the GIPS conference in Boston, they did talk about, survey. Over half of OCIO firms are already showing track records of comparable clients. Mostly, I believe, representative account clients as opposed to related account clients. So this is going to force firms, just like it's forced wealth advisors and everyone else that isn't GIPS compliant, to create composites. And they're going to have to be showing total fund returns, but they could show asset class performance as kind of a supporting attribution. I do think with, when you have private equity returns and real estate and, some of these other illiquid assets, and you just have a total fund return, it's perhaps not as meaningful as having some of the asset class returns broken out, but certainly the new SEC marketing rules, extracted performance rules are really going to mean that could really only be shown either as attribution supporting a total fund return, or they could show a representative accounts extracted sector asset class returns. So that's what I have on that, unless anybody on the call has another question. Okay.
So our next topic was ESG. There were 2 sessions at the conference on ESG. And the thing I think for a lot of firms to know, there's a lot of interest around the global ESG disclosure standards. Those came out about a year ago. The assurance procedures, we've actually confirmed that they will be issued by year end, even if it is as of 11:59 on December 31st. They will be issued by year end, which means that firms can start receiving opinions, essentially, that they've disclosed the right amount of information according to the ESG disclosure standards. So with this, the standards are designed and implemented, and they're in alignment with the GIPS standards. Similar requirements that are included in them are the creation of policies and procedures, the notification of CFA Institute for compliance, and then the preparation of a report for prospects that includes required disclosures. So the ESG disclosure standards, they are disclosure standards. They are not performance standards. And I think that's an important piece to note. Just one Q&A here that was relevant, and it's been asked quite a few times. Will there be a GIPS/ESG compliance standard that can be verified and then used in client marketing? And if so, how far in the future might this be? So the CFA Institute staff were very clear that currently there will not be a combined GIPS report, ESG disclosure report standard, that those two would have to be provided to separately yet together. So, firms will have to comply with both independently of each other. And I think that for some firms, that's a lot of paperwork. We'll see how it goes, and happy to discuss more on this particular topic. And Kim, you have model portfolio programs.
Yeah, so not to be confused with model net of fee numbers or model hypothetical returns that a manager is calculating. We're talking about advisory only assets, and to go onto a TAMP, for example, InvestNet platform, or working with a financial advisor platform. So this is like a $12 trillion segment of the market. And so it's really, really grown. and lots and lots of benefits, I think, have evolved from the wrap fee model, where there was a little, a little overlap between, okay, who's responsible for implementing and managing to the client's needs, and who has the liability there, and the books and records. And this is different, where this is really advisory only, and the trading and implementation really does stay with the financial advisors or the platform, not with the manager. So it's advisory only for GIPS purposes, and it still can be shown. And for a lot of firms, this model of distributing their strategies is really effective, and gives them, it's a big part of their firm's assets under advisement. So they want to show those assets, and it's extra information, but it has to be labeled supplemental. The assets are supplemental. You can also show advisory performance as supplemental information, but you need to be careful there, because you do need books and records to support your returns, whatever, if you're showing them as supplemental information. So one distinction made at the conference was for distributing GIPS reports. We all know you have to show prospective clients or investors a GIPS report when they become prospective clients or investors. However, if they've only expressed interest in a model, you do not have to show them a GIPS report, because your GIPS reports are typically, actual assets that you are managing. So if a client wants to become an actual client of the firm, is when the GIPS report is required. From an SEC perspective, it really depends. If the platform is showing actual performance achieved by accounts, then the actual performance rules apply. But if what you have is model performance of your paper portfolio, that's actually hypothetical. And so that's going to be subject to the SEC marketing rule requirements for presenting hypothetical performance, which means very special policies, which means you can't broadly distribute anything, because you have to make sure that the recipients have the ability to be discerning and educated, and ask, to have the sophistication to receive that kind of information. So be careful, I guess, was one of the takeaways with your advisory performance. If you're showing that, advisory assets, not so much of a problem. I think you can substantiate those pretty easily. But definitely an area that's grown, and some good clarifications offered during this session. The sample question, in the case of an advisory only question where models are provided to an intermediary, which is very common, and the intermediary has the discretion, are you required to give the GIPS compliant reports to the intermediary? And in this particular case, it's a little bit of a different flavor than an actual client expressing interest in your model, because they're going to turn around and market to prospective clients. They would be considered a prospective client under the GIPS definition, and they would be required to be provided with a GIPS report. So InvestNet would have to get the GIPS report, but firms that want to, but a client that wants to invest with InvestNet that reached out to you would not have to get a GIPS report from you. Oh, we got a question.
Okay. I can't see them, Kim, so if you want to go ahead and take it, go for it.
Oh, you didn't see it. I don't know if I can get back to it. Okay, Stacy, yes. For model programs, how would this affect fact sheets being distributed to advisors using the strategy? So we have seen a lot of platforms reaching out very specifically, asking for firms to have made all of the updates to comply with the marketing rule, because that is how they are going to comply as broker dealers, as dual registrants. they're just going to make sure that you, the RIA, have all of the required SEC marketing rule disclosures in your fact sheets. And GIPS reports, the whole standalone versus if it's shown with a fact sheet, depending on how you deliver the information to the platform, what the advice was at the conference was, yes, they need to get a GIPS report, whether or not if it goes with a fact sheet that already has the 1, 5, and 10, then you're going to be fine as long as all your disclosures are in that deliverable somewhere. Is that kind of what your question was, or is there more? All right.
So, and then Manny, you have your hand raised, so please feel free to unmute yourself and ask.
Thanks, Janice. I had a quick question specifically on this model delivery subject. So if we have an SMA strategy where we charge our clients 1%, and then we have a separate model portfolio product that's based off this SMA strategy, what model fee would you recommend that we use for the model fee marketing materials in that scenario? Because it wouldn't be 1%, that's going to be likely lower. Would you recommend still using the 1% model fee, or you're using something more representative of what we would charge our end client, which would be the model portfolio delivery?
If I were to jump in there and answer that, I would say that is the relevant fee that you are offering. And even using old SMA guidance from the SEC, from CFA Institute, you can definitely have platform specific fees separate from your composite. And there's nothing, they don't want you necessarily creating composites based on fees, but they appreciate in wrap scenarios that there can be such different fees that it might make sense for you to apply different fees to different recipients. And there would be nothing misleading about showing your model, your clients directly investing through you as opposed through the SMA, showing them the fee that's applicable for them.
Well, and just to add to that, it's actually, Manny, it's funny you mentioned this because it's one of our case studies that we have at the end here. So I'll skip over it and we'll just talk about it right now. But I think the key takeaway from the SEC is you need to make sure to understand in those model platforms what is being shown to the client, to the end prospective client, and that those returns are representative of what that end prospect could expect to receive. And that you can't just say, well, it's a model delivery program, it's their responsibility. If you have to understand how your performance is being used, and then make sure that it's representative. So that was what I took away from a couple different conversations during that time. Does that make sense?
Yeah, that's an interesting point, because we were, I was in the mindset, well, I'm delivering my materials to my client, the model delivery portfolio client. But yes, they're going to use it in a different manner, and probably with retail clients. And it's certainly most likely going to be a fee a little bit higher than, 60, 80 basis points that end client would pay. So that's a good point. Thank you for pointing that out.
We have a client that we just walked through this with, and it's more of a dual contract situation, but basically what they have now are two GIPS reports, one that's net of 2.5% and one that's net of 0.75%. The 2.5% goes to the wrap or dual contract providers, and then the 0.75 is what they charge their SMA clients, and that is specific for those. So, and this also means that they're now calculating the 1, 5, and 10 year, and since inception, if they choose to show that, net of each of those, and then having to update. So it can be cumbersome. I think the argument we made with them is that the other option is to just do it net of 2.5. And of course, they did not like that at all. If they wanted only one presentation, because it would be misleading to show the dual contract provider 0.75.
Alongside the other column of returns, you mean?
Yeah, yeah.
Or
So
in
they
lieu
actually
of.
have two separate presentations, one 2.5 and one 0.75. So they're not
Got
showing
it.
them together.
Got it.
Sometimes I think the more we talk about this, the more muddled it gets.
Yeah.
We're trying to clarify and we're actually muddling. And Stacy did circle back. So the question really is, if this is hypothetical performance of model assets that you're showing calculated on a paper portfolio, and then you give it to the platform and then they mass distribute it. What about that scenario?
Do you want me to talk about this? Because I just went through this with the client.
Please.
Okay. So we had a client bring up a scenario in which they're sitting in a room with a bunch of, let's for simplicity's sake, say UBS advisors who they've deemed are financially I can't think of the word right now. There's a word, smart enough to be able to interpret the performance results of hypothetical performance. And is that considered, can a room full of advisors be considered one-on-one and therefore not violate the SEC's rule for hypothetical performance only being provided in one-on-one scenarios? And what we went back to, oh, you were saying it's based on actual composite performance, but it's
That's gonna be fine.
hypothetical. Huh?
But they don't do the trading.
I see. I'm a little confused. So if you know what this question is, go for it.
Sure, I think it's referring to what they said. What our takeaway was from the GIPS conference was that for GIPS purposes, advisory only assets are supplemental information. For SEC purposes, if it's not based on actual performance, if it's based on if it's based on a paper portfolio, then it's hypothetical. But if it is based, so I guess they're two different things and you don't want to mix them up.
Yeah.
So for GIPS purposes, these advisory only are supplemental information, but they're not hypothetical. And for SEC purposes, if it's based on actual accounts, I don't, if it's based on an actual composite of accounts, it's not hypothetical, unless it's a paper portfolio. So even though they're doing the trading, and you want to have books and records, I guess, and either you're shadowing that performance on your own portfolio accounting system for that to be actual accounts, or you have some accounts in-house that are in fact you're managing and trading, and then you have and you use those accounts to give to the paper platform providers. In both of those scenarios, you still have actual performance. So it's not a problem of hypothetical.
Yeah. And I would say, Stacy, please feel free to reach out to us. We're happy to have a phone call about this too. Get all of the details. Any additional questions? If not, we can go to, I think we have 2 case studies now, since we kind of already addressed one. So Kim briefly talked about this at the very beginning, and it was based on net of actual fees and whether or not when a firm is using net of actual fees, composite net performance using actual fees, do they need to switch possibly to using a net of model? This has been a question amongst many firms. We've seen a lot of firms move to a net of model in the last year. And quite frankly, it's easier to calculate, but it does present a little more work on the advisor's side just because it's generally not done within a system. So For example, let's say your current highest management fee is 1%, but historically it may have been as high as 1.5%. And the gross and net difference ranges from 0.4 to 0.75 depending on the year. So that's just the gross net spread, the difference between the two. Given the new rule, can this client show net of actual fees? And again, it goes back to the take home. So the SEC marketing rule is clear that net returns must be representative of what a prospective client could expect to receive. Given that some of the net and gross differences are as low as 0.4%, the net returns would not be representative of what that prospective client could expect to receive, especially if right now it's a 1% highest fee. And let's say the 2021 gross net spread is, 0.4%, that's problematic. It could be considered misleading to that prospective client. So our recommendation is to change that composite net performance to a model fee and make sure that it's representative during the time period. With the GIPS standards, if you're claiming compliance with the GIPS standards, your net performance must not be higher than if actual fees were used at any point in the history. So keep that in mind as you go forward, because there's a nuance between GIPS and the SEC marketing rule. And the SEC marketing rule says that you can show your highest performance using the highest fee that that prospective client could expect to receive now. So you could use 0.75% if that's what they could expect to receive now. But if in the past that gross net spread was higher, you need to make sure that you're accounting for that. And again, this is kind of number soup. So if you have specific scenarios, please feel free to let us know or give us a call. With that, our case study number 2, we'll put this in the slides and send the slides along, but this is what we were talking about before with Manny, and there's options listed here. Kind of our last and final case study, which we have about 5 minutes for, is hypothetical performance, and Kim is going to take this one. Unless somebody has other questions, because we cannot do this one.
Yeah. So the final case study is really looking at firms that have used back-tested numbers, and a lot of firms are kind of like, can we no longer use these at all? Or are there scenarios in which we could still use them, and what would that look like to comply with the rule and still be able to have back-tested numbers? And in this case study, back to 2000 until the actual account started being managed in 2015, and applying that strategy to actual accounts going forward. So in their particular models at this firm, we're going to have multiple models, and we're going to have clients typically invested in, 2, 3, 4 of any of their models. And so you also have extracted performance considerations as well, if you're just showing a particular model versus the total account returns for clients that are invested in different mixes of those models. So this is not that unusual for wealth advisors. And we came up with 3 options. And I'm not seeing, okay, there it is. Hey, option 1, continue to show hypothetical. But in order to do this, you're going to need to create actual total returns of the portfolios that are 100% allocated to single strategies, if you have any. And obviously, if every single account comes in and you're putting them in at least 3 or 4 different models, then you're not going to have one. But I think certainly in this particular case study, we found that there are some clients that are just interested in and invested in one single model, so that you can create an actual return history from 2015 forward. And then because the advertising marketing rule wants to make sure that hypothetical performance is only shown to sophisticated investors who are smart enough. Yeah. then if they don't have the knowledge to be able to interpret those hypothetical results, you would have to actually have policies in place. You can't show them the back-tested numbers. You could only show them the actual performance. But if you can demonstrate that you have spent some time educating them about hypothetical returns and that, you know, the hypothetical returns can be presented, then you got to have lots of policies and procedures documented, as well as, you know, books and records for, hey, yes, we had this conversation, and yes, they did meet the criteria, or no, they did not, and relevant presentations depending on what conclusion you come to. In this, another option, and I think the other reason, what I didn't underscore in option one is, if you have 100% actual account returns in any model, then you can compare and see if in fact the 100% returns for the actual accounts is representative of what you're showing in your model. What you can't do is just think that your model returns are representative of what your actual accounts are getting, right? Not in this new environment since November 4th. If you're going to put model returns out there, especially, you know, if they've just been back tested paper portfolios, you got to go, okay, what are my actual accounts doing? And actually make that comparison. And if you pass the test that they are materially similar, then you can continue to show model. Or in example number 2, we're like, well, what if you continue to show, starting with the live performance in 2015, you show segment returns. Segment extracted returns for the individual models are also considered hypothetical, but it's a different kind of hypothetical, right? It's not a paper portfolio, it's actual account segment returns. So in this instance, it still has to meet all of the hypothetical documentation policies. It has to be, the clients have to be sophisticated. You have to have all the controls and limits on any kind of broad distribution cannot do. But in terms of having materials to distribute one-on-one, you could do this and actually use the segment returns from the models of actual accounts. And you could still link them because you're linking hypothetical to hypothetical, and you just have to disclose, you know, paper portfolios up until 2015. So this is a case study of another option that a firm could go and still be able to have a track record. The third option would be to say, you know what, 2015 forward, we are going to just switch to actual performance. And at that point, you're going to either not show or certainly not link the prior firm performance. And if, you know, if you have those 100% allocated accounts and you can see performance is similar, you could still show it unlinked or just quit showing it altogether. And that's going to make it a lot easier, actually. And you know what? 7 years of performance is a good track record. So this is probably where we would end up saying, you know what, you can let that hypothetical performance go and use your actual. And this is where we would want firms to get excited about going. But we certainly are not going to make your business decisions for you. So just wanted to give you a few different options on this today. That's it, Janice.
Yeah, I just want to leave with kind of to wrap it all up. What's the most important thing every person from the conference should go back to their office and do to improve their firm's SEC and GIPS compliance? This was an actual question asked at the conference, and I don't believe it was answered, but we kind of came up with our own answer of what we think are the most important things right now. And it's really complete a review of the firm's policies and procedures as it relates to the SEC and GIPS. Making sure that performance is your policies and procedures for how you calculate performance or choose representative accounts. Those are all documented well. And then review those your firm's marketing materials. I think actually the biggest piece here is making sure that you have adequate checks and balances for accuracy, books and records, and that all staff is sufficiently trained, especially for newly created materials. And then lastly, determine how the firm will limit or eliminate the use of prior marketing materials that are not in compliance with the new rule. It is so easy. We've seen this time and time again, like with the changeover from GIPS 2010 to 2020, how easily it is to grab that prior marketing material that's no longer in compliance. So I think this is maybe a really big thing to remember and to make sure you're implementing at your firms. So thank you so much for your time.